Right, let me show you on the volatility radar, and I'm using the example of 3i group here. Now, I look at three different things on here, and again, remember my starting point will be these indicators down here, which will be the data mines. That's what I'm starting off with. I then are only clicking on these subsequently. So what does that involve? Well, what it means is this. Having got a particular stop, maybe from my bearish momentum or bullish momentum, if I click on the volatility indicator, I'll see something like this. Now, what does that mean? Well, first of all, it's showing me the standard deviation. The standard deviation tells me how far the price has moved from its average, and the average price is based over my proprietary outlook period, so the period that I look over, which over years and months I think is the most accurate for giving me a good reading for the near future. Now, in general terms, to give me a flavour of how things are progressing, if the standard deviation figure is relatively high to what it's been, like over here, it's relatively high, then that usually suggests to me that we're going to go through a period of, and it might only be a few weeks, but a few weeks of quietness. We've gone through a period of high volatility, so it's about to consolidate or go sideways. Equally, if we go through a period of relatively low volatility, it suggests that sooner or later, and usually quite soon, we're about to get quite a move upwards. And the reason for that is volatility tends to revert back towards its average. And as it reverts, either if it goes from an extreme to lower, the stock moves quieten down, or vice versa. Now, the reason for that is it gives me some indication of how likely a move is, and how likely and when that's about to occur. It's not a specific move such as, oh, if the volatility indicator hits 20 and then starts moving low, that's a sell signal. It's not like that. It's more to get a flavour. So here it's suggesting to me we're probably going to get a period of some degree of quietness. Now, just to show how the volatility indicator can work, I mean, look, here we had relatively high volatility. It started to peak off, and then of course it shot up, as you can see there, and we started getting increased volatility again. So it's not always the strictest move. It doesn't necessarily mean it's bound to go lower, but it can give some degree of indication of when a trend may be about to form. And as I say, a trend like here is about to form after a relatively quiet period here, and the relatively quiet period exemplified by this. And indeed, when we saw relatively new low over there, you could see how it then transpired. So that's the standard deviation. The beta is again a measure of volatility. What that tells me is how the stock is moving in relation to the broader market, i.e. the FTSE 100 in this case. The beta is a measure of the degree to which the stock is expected to rise and fall in proportion to the rise and fall of the index. So if it's highly correlated, so it's moving very much in tandem, then what that tells me is this stock is going to be as volatile as the index, and I'm not going to be able to outperform the index. And I don't want something where I can't outperform the index. So the beta is a measure where I'm thinking, oh, I don't want something which is going to be so moving directly with the index necessarily, especially if I think the index is going to fall. So that's why I look at that, and it really is just a gauge. It's just a glance rather than anything more detailed. And then you've got the volatility indicator again, does what it says. The more rapid the movement, the greater the volatility. High volatility is generally supposed to be greater risk. So if I'm looking at putting in a very tight stop loss, then I don't necessarily want a stock which has got a very high degree of volatility relative, and by high I mean relative to where it's been in the past, because again it suggests that the stop loss is going to be hit. Equally, I do want it to have relatively high volatility, so I think it's trending. So how do I balance the two? Well, it's to give me a measure of the fact that I don't necessarily want a very tight stop. I mean, for instance, if you've got something rising relatively sharply, like let me show you this part over here, and you've got the volatility rising, then I might not want to put a stop loss at a one-day low. I might want to do it at a two-day price low like here, because it might be that a one-day low, like just where it's equal there, because it's volatile, the stock will go to a one-day low and then continue upwards. And if I put a tight stop loss, then I'll get stopped out before the stock continues. So that's why I want to look at the volatility direction. If I see volatility increasing with the rising uptrend, I'm thinking, okay, this is still going to uptrend higher because the volatility is rising after a quiet period, so it's still trending, but I don't want to put too tight a stop loss for the reason I just mentioned. So it's a balance between making sure it's got enough volatility to trend higher, but not so much volatility that it can knock out a very tight stop loss. And by that, what you do is you make sure the stop loss isn't too tight.